Thanks, Adam. Thanks very much. And it's really nice to be here with you today. So obviously you've heard about large cap growth, large cap value, and a sort of long short fund. Now we're here to talk about small caps and why we're excited by small caps, and actually why we think right now is a really good opportunity to be looking at global small caps. So in trying to frame the conversation, we thought, what's a good analogy to get people sort of excited by smalls and understand how we think about the marketplace? And what better way to start than to start with rugby? And unfortunately, many of you will remember this picture. This is the Wallabies not doing so well last year in the World Cup, sadly. There were some days like we feel like this actually when we pick a bad stock. I'm joking, but obviously, if you were running the Wallabies or given or tasked with the chance of, how do you turn the Wallabies around? How do you pick a good all-star team? How would you do it? So we thought, okay, we'll pick Coach Eric Taylor from Friday Night Lights. Great TV series if you've seen that. And if you were him and you were saying, okay, how do you build an all-star team to replace or augment the Wallabies and create a great portfolio or a great team to go and well beat? Well, the first thing is, would you be looking at players in your street, your neighbours maybe? Would you be looking in the suburb, the city you live in? Or if you're allowed, would you look globally for the best possible talent you could find and pick the best team you could around the world? Obviously the latter, you'd be looking globally. And I guess this is what excites us about global small caps. We invest in domestic small caps in Australia, and there's, on this chart here, you can see there's about 500 or so that meet our criteria by market cap. But if you look globally, and we only invest in developed markets, so we're not looking for Brazilian or Russian or Chinese players, even though there's probably some good footy players in those countries. We're mainly in, only developed markets, so people who speak English, report with IFRS accounting. But with that constriction, you still have 8,000 shares to pick from. That's an enormous number, and it really excites us. A corollary of that is that because it's such a large number of stocks, there really is quite poor coverage. And that's what gets us out of bed every day and really makes us excited about looking for unearthed value. If you look at the NASDAQ, there's almost 30 analysts covering Google and Microsoft and Facebook, poring over the same balance sheets. They've all got great qualifications. They're typically the senior analysts at large firms, and they're well credentialed. If you go down the market cap spectrum and look at small caps, there's only 4 to 5 analysts on average covering these stocks. In many cases, there's 0. And they're also the junior team members. Not that the junior guys are less intelligent, but they're just less experienced. And we love that lack of coverage. And the analogy there in coaching terms would be, would you run around and look at the big universities where there's 25 talent scouts looking for the best players? Or would you go creep around and look for really good players in small colleges where there's no talent scouts looking? And that's the same kind of analogy we feel we have when we're looking for global stocks in the small cap universe. The question is, okay, why now? And the great thing about small companies is that over the long run, this is the longest chart we could find. So the small cap index was created about 30 years ago. That's the light blue line, and the dark blue line is the large caps. You can see that over 30 years, there has been a small cap return advantage globally by almost 2%. Quite different to Australia, where it's actually been a tougher market for small caps, but internationally it's been a decent premium on small caps. So we're looking for in a pool of faster running players, if you like, in terms of back to the rugby analogy. But what's even more exciting is at the moment, the small caps have materially underperformed. And it kind of makes sense, right? We've had a period of rising rates, high inflation, and people have kind of fled back to liquidity and known names. So the large cap stocks have done very well, and people have kind of deserted the small caps because of the economic uncertainty. They're more economically sensitive businesses. And so there's been almost a 17-18% gap in terms of relative return of smalls versus large. But we do know over time that gap closes and there's a really good relative return from smalls versus large. And the other great thing about small caps is that at the moment, they're incredibly cheap. So we're using an EV to EBIT multiple here. If you look at EV to sales or price to earnings, any other major multiple that people look at, this is the relative valuation of large versus small. Small caps have never looked cheaper on a relative basis to large caps, so there's a really good opportunity to be buying them. And we also know that when the market does come out of a correction, like we've seen, out of the dot-com sell-off, for example, small caps did incredibly well. During the GFC, they sold off heavily into the GFC event, but they rallied really strongly. And then more recently with COVID again, they rallied hard. So when we've had that lagging period in performance, you get a really good boost by switching back into small caps versus large. So I thought we'd just lift the lid on some of the players that Coach Eric Taylor's found looking around the world to give you some sense of what kind of small caps we're finding, why they're exciting, and also maybe show how the Spheria process works in action. So one name that some of you might have heard is a stock called Ferguson. It's a plumbing distribution business in the States. And it really fits, I think, and demonstrates the Spheria investment process quite well. So the first chart here is a cash flow conversion chart. We love these charts. They're in all of our models, and they really try to scrub down reported earnings and actual cash flow. And one of the things we like doing is peeling back that earnings and cash flow and making sure there's a good reconciliation. You find high quality businesses do reconcile cash and earnings very well. We can value cash pays dividends, cash allows you to buy back stock, etc. The second chart there just shows the return on capital metrics, which are incredibly strong with this franchise. It's been taking market share. It's the number one plumbing distribution business in the States. Has been taking market share for about 10 years now. And those incremental returns on capital are incredibly high at say 40, 50%. And we like to draw the analogy between, we often say that the problem with being invested in small caps in Australia is it's a very, very small space. And high quality names in Australia are really crowded. So a good proxy in Australia is a stock called Reece. Many of you will know. They actually have operations in the States as well. But Reece Plumbing, great business, family controlled, good free cash flow business. But trades on 27 times EBIT, almost 30 times EBIT. Looking internationally, things like Ferguson have pretty much the same growth rate as Reece. Trade on about half the multiple, about 14 times EBIT. So we love that kind of relative valuation opportunity where money is not being compressed into a very narrow, tight field.
So another company that we own that we're really excited by is a company that goes by the name of NAPCO Security Technologies. They're a US manufacturer of electronic security, access control and digital locking equipment that are sold mainly into commercial and industrial applications. So think security apparatus that goes into shopping centres, into office buildings, and just into schools and colleges and universities. Philosophically, I'd describe this company as being obsessively focused on controlling everything about what they do. So what does that mean? They offer products across the entire value chain. So they sell alarms, they sell locks, they sell access control, and they sell connectivity for back-to-base monitoring. Not only that, they are vertically integrated into both design and manufacture. So what does all that obsession translate into? It translates into a better product, a better and more reliable product, and we can see evidence of that in them growing market share consistently over the last few years in what is itself a growing market. So what else do we like about this business? I mentioned connectivity earlier. More than half of the earnings generated from this business come in the form of high margin, recurring, essentially subscription revenues that they receive in exchange for providing that connectivity, that back-to-base connectivity, that service. And Marcus spoke about our focus on cash flow and balance sheet. This company is a prime example of the type of thing that we're very attracted to. You can see on the top left there, we've got cash conversion close to 100%, which is a fantastic effort for a business growing as quickly as NAPCO. They have a net cash balance sheet. They've been buying back stock, and you can see that they're generating very strong return on capital there on the bottom left.
Awesome, Dan. And then last example here is one we like talking about, which is Acceleron. And Acceleron is interesting because it makes the world's biggest turbochargers. Who doesn't like a good turbocharger? You can see that these are huge turbochargers fit onto massive diesel engines that sit inside ships, and they are the world leader in this field. Acceleron itself was a spin-off from ABB, which is a large Swedish engineering company. It listed about 2 years ago, so there wasn't a lot of history that people knew about. We read the prospectus, got our heads around their market share. They're world leaders with a 40% market share. Great thing about turbos is that because they're so hard-working, like they get inside these engines, they grind away for 5,000 hours a year. The blades are spinning at close to the speed of sound. And they're doing incredible things for both efficiency and the environment because they add 10 to 12% efficiency of these massive engines, reduce CO2 emissions and NOx emissions, which are obviously all good for ESG credentials. But they require an incredible amount of servicing. And these guys have 100 service centers around the world. And 3/4 of their revenue and earnings come from actually servicing these turbochargers. They install them, have a life of 30 years, and they need to be serviced every year or two to make sure they're operating efficiently. So great recurring business again, market leader. Again, ticks all our boxes. Free cash flow conversion very high. Balance sheet's very, very modestly geared, almost net cash, and valuation was extremely attractive when we bought it. This stock would probably trade on a 50 to 100% premium if it listed in Australia. So they're the kind of names we're finding around the world that just show you that valuation opportunity anomaly between Australia and globally, and I think would be a great addition to Coach Eric Taylor's team.
So that's all well and good, but why Spheria, I hear you ask? Well, now that you've been persuaded that global small caps is a good place to look at, but not just a good place to look at, but just a good place to look now. On top of that, we can provide you with the benefit of our experience in our process. So what does that mean? Well, it shouldn't surprise you, given everything that we've said about our focus on cash flow and balance sheet, that we offer, our portfolio offers slightly better valuation metrics versus the index. We offer a superior free cash flow yield versus the index and a vastly superior return on equity versus the market. The average stock in our portfolio is somewhat bigger than the average stock in the index at about $5 billion, which, just to put that into context, is about the size of a domestic mid-50 company. So lower valuation, better free cash flow yield and higher returning businesses. And just to hammer home that point about balance sheets, 70% of the companies that we own in our portfolio have net cash balance sheets. These are the numbers. We're coming up to our 5-year anniversary. It's about 2 weeks away. We're quite proud of the fact that we've been able to outperform fairly consistently since inception over virtually every time period there. And not just that, but the thing that we're most proud about is the fact that we've been able to do it with lower risk than the benchmark. So we've quoted beta and volatility up there. You can see we've got a lower beta and a lower volatility, level of volatility than the benchmark. So been able to generate superior returns at lower risk, and that point on lower risk, it shouldn't be a surprise to you, given that we're buying businesses with very low or no net debt and strong cash generative characteristics. So with all that, thank you very much for your attention.
Thanks very much.